Okay, hi everyone. Okay, thank you for joining me today for this webinar on the US elections. Um, I think it's a very interesting time. We could be looking at history in the making, considering that if the current Vice President Harris were to win, she will be the first female US president. So, and current odds does shows that she has sort of a slightly higher edge than Trump in terms of becoming the next U.S. president. But of course, we are still probably a 1 month, slightly more than 1 month out. Things can still change. But as of now, the odds are slightly leaning towards Harris as the potential next U.S. president. And for today's webinar, we understand that Trump and Harris will continue to come up with an economic agenda this week. We will be awaiting more clarity on that. So today's presentation will mainly be what they have said so far and where their policy direction is leading towards, what areas of focus are they turning to, and then from there we see potentially which sectors may benefit. But of course we have to understand that being a president, you also have to have the backing of the Congress, the US House and the US Senate, because what we have seen is that over the past historical instances where we have a split government meaning we do not have a blue wave where the Democrats dominate the whole government, or we have a red wave where the Republican dominate the House, the Senate, and the president's seat. Generally, when we have a split government, what we observe is that policies could be harder to pass through. There may be some form of a resistance if we have a government that has slightly divided. So from there, we also have to consider whether moving forward, whether we have a divided government or not. So later I'll show you some numbers just to show what to expect. When we have a divided government versus when we have a blue wave or a red wave. So moving on, just some disclaimer. Do take note that this presentation is purely for educational and information purposes only. We are not giving any, hard buy or sell call. When you do your own trading, please do your own due diligence. So this presentation is mainly just, just me sharing my views with you and what we can potentially take away from the US election. So this is me. I think just 3 points that you may want to take note. Number one is my Twitter. So the handle is ip_IG. But I understand that many of you tends to turn to Telegram for finance content. We do have a Telegram group. It's called IG Asia. You can just do a simple search on Telegram, IG Asia, and you can just join the group. It's totally free, and we will feature commentaries or content pieces from analysts across the globe for you to, just for you to digest and to position your trades. Instagram, more for bite-sized news. But if you want, we have an Instagram account at igcom.sg. So please feel free to join. Okay, I think let's just dive deep into the content. But before that, maybe just if you can just type in the question box or even the chat box whether you are leaning more towards a Trump presidency or a Harris presidency. Of course, we are not trying to be political here. This webinar is purely just to see how we position ourselves in the market, but really just want to get some of your views on, how many of you are leaning more towards a Trump presidency and how many of you are leaning more towards a Harris kind of presidency. So just feel free to type in the chat on what you think. Okay, I saw some Trump, Harris, kind of a even split. Harris, okay. Now I think leaning more towards Harris. Okay, kind of interesting. I will say that overall probably slightly more is leaning towards Democrats a win for the president's seat, which is actually what the current polls are showing. So you just look at the current polls. So previously, Biden was lagging by quite a fair bit. After the first presidential debate, the gap kind of widened. That create more pressure on him to really withdraw from the presidential race. Thereafter, we've seen Harris stepping up, and the sort of the table has turned with her presence. Currently, she is in the lead, but I would say that the lead is not too significant. It is a lead of around just a slight 2.2% margin. Okay, so while she is in the lead, there are still some room towards the 5th November timeline, and odds can definitely change. And we know that this week both candidates are coming up very frantically on any updated economic agenda. They're going to address the public on that. So I will be watching on whether there are any changes arising. But overall, we are still 1 month out, and things can turn very volatile, especially when the gap kind of widen. Because a 2.2% margin is definitely not very significant. And why is this so? Because if you were to backtrack to 2016, if you were to recall, very interesting time, we have Hillary Clinton versus Donald Trump. And all along, everyone believed that Clinton is the hot favorite, that Clinton will be set to win the presidency. Okay, but the outcome that we got is that surprises can happen. At around this time in 2016, Clinton actually lead Trump by 3%, which is wider than what we have seen now, 2.2%. So Clinton was leading by 3%. Even on election day itself, the lead was 1.8%. Not a lot, but nevertheless, she was still leading. And ultimately, the outcome we got is that Trump emerged as the eventual winner. And I think one of the takeaway is that the outcome of the US presidential election is not decided by a popular vote. So Clinton did won the popular seat, meaning she got majority of the vote, but they go by an electoral voting system. And eventually, even though Clinton is the more popular one, Trump eventually emerged as the winner. So polls can sort of, give us an idea, but it doesn't give us that determining factor is the winner. And there is definitely this room for potential surprise to happen. And if we look at the polling errors, over the past 2 years, back in 2016, back in 2020, polling tends to sort of overestimate a Democratic victory. So previously, back in 2020, markets were definitely leaning very heavily towards a Biden win. He did won, but it's actually by a lesser margin than what the polls actually suggested. Okay, so what this means is that, of course, not to say that we shouldn't depend on depend on polling, but it just gives us an initial idea. As we head into the presidential day, definitely we may expect, we have to be prepared that some surprises can definitely happen. I think the US presidential election, no doubt, will boil down to what they call the battleground states. So these are the states where there isn't a clear history of which sides they will vote for. And this is where, the candidates may have to sort of fight harder in order to win over the people in these states. If you just look at the breakdown of many of these top battleground states, it is quite a fair fight, I would say. Some leaning towards Harris, some leaning towards Trump. Overall, it does seem that Trump has a very slight edge of 0.1, definitely not significant in my view, but it's a very balanced fight for now. So moving forward, we may expect, the presidential candidate to really step up and to rally more support among these battleground states. They really have to convince the public about their economic agenda. We know that currently we still have an inflation in the US that is above target. Jobs market are softening. Of course, we are not looking at recessionary kind of level just yet, but no doubt unemployment rate is on the picked up, 4.2% in previous month. Jobs growth has also slowed, even if we look at some of the economic data. Overnight, we got that US consumer confidence numbers, downside surprise right there. So clearly, economic conditions are still softening, definitely softening, and inflation is still above target. So they will really have to convince the public that their policies will be the better one, and will be the best for US. So I think the battleground states will definitely be on watch, and as we head into the election day itself, many of these numbers can definitely change. But as of now, it does show that it is a very balanced fight, and that it can swing either way as to who will be the eventual president. Okay, with that out of the way, I know there's a lot of uncertainty that is being put out right there. That very slight margin lead by Harris, battleground states very mixed. Can't really get that affirmation, of a clear presidential winner yet. But now let's just focus on some of the policies that they have laid out, and from there, how can we actually position ourselves post-election if either sides were to win. So these are the three scenarios that we have, just to keep it simple. Of course, one is what we call that blue wave, that democratic sweep, where the Democrats may win the president and also dominate the House and Senate. Usually in this case, because of that dominant presence within one party by itself, any form of fiscal stimulus plans may be passed more easily. Okay, and when we look at what Harris has actually proposed in terms of her views on where spending should go, we could be looking at a relatively smaller budget deficit. Of course, that tax cut and jobs act that previously Trump put in place, that may be put in view in that both sides will try to extend it. Okay, many of those components may be set to expire by end 2025. So both parties will try to extend it. But at least for Harris, what we are looking at is that it may be a more measured extension. We may be looking at several components as compared to a red wave, where a Republican dominate the whole government. They will be more freely pushing for a sort of, I would say, a little limit kind of extension. They will be more aggressive as compared to a blue wave itself. And of course, when we have a Democrats sweep, foreign policies will sort of be friendlier, I believe. Generally, we are looking at more policy continuity from the current Biden administration, where it is really about the US government bending around its allies to sort of further its aim. We could be looking at lesser uncertainty around trade, around geopolitical relations, as compared to a red wave where we have heard Trump making several aggressive statements. If you were to follow the news over the past few weeks, I think Trump can be an aggressive figure in a way. We have heard things like, they want Taiwan to pay for defense. If not, they may actually, choose not to actually defend its allies. So they want Taiwan to pay. It's more of a transactional kind of a foreign relations we are looking at in a Trump presidency. He also mentioned that NATO is not spending enough in terms of defense, and he wants to push it up higher. And if NATO doesn't meet his requirement, he's not going to defend the allies. So of course, these are some of the more aggressive statements that he has put out. But generally, what this trigger is that there could be more uncertainty around where things are going with a Trump presidency in terms of foreign policies. And one of the key highlights definitely that Trump wanted to enact is that tariff on trading partners. So in a way, he want to keep key strategic industry within the US. And if you were to, sort of, if you were to show that in a way, you are trying to take advantage in his terms, take advantage of US, he wouldn't hesitate to really implement stronger tariffs. And we know that tariff can be bad for both the consumers and the companies because generally the burden of tariffs tends to fall on the consumers itself. So when we have a tariff, generally economic growth are cast more with more uncertainty. We could be looking at a slower form of economic growth, but of course, very much is still up in the air. We know that he's leaning towards that tariff approach, but by how much or how eventual, the extent could be enforced is still very much a question mark at current point in time. But definitely with a Trump presidency, foreign policies will carry more uncertainty, and with a Democratic presidency, the foreign policies may be more certain. So later I'll just share, how can we actually position around that. Some of it will come in form of gold prices, the US dollar as well. Okay, but generally in a with a blue or red wave, generally fiscal plans can be passed more easily. Whereas when we have that divided government, when neither side is able to fully dominate the government seat, what we have is a potential gridlock in fiscal plans. And generally, this is what markets want. Okay, they do not want a fully dominant government to push through policies very easily because policy means changes. Okay, and markets doesn't like uncertainty. So when you have a divided, sort of a divided government, what this means is that changes can be more measured, changes can be met with resistance. Ultimately, the impact may not be so huge to trigger, a lot of changes and uncertainty. So generally, when we have a divided government, that is what markets like, and that is what they prefer by itself. And in this case, currently, we have a divided government, whereby neither side is able to dominate fully the decision making. And if you have a divided government, I believe what this means is that there will be more policy continuity. Of course, some of the key factors around trade relations with China, I think that tough stance should continue to play out either way. There isn't much incentive for the government to deviate from that. So I think the efforts to contain China's growth in many strategic areas will remain, but the approach may differ, where Trump presidency will clearly lean towards being a tariff, whereas for a Democratic presidency, there may be some form of a trade restriction in place. But generally, Democrats will try to focus more on subsidies for their own industry, as compared to a more aggressive kind of punitive measures on China, for example. That will come in the form of a Trump presidency. So the approach can be different, but generally the tough stance to contain China's growth should remain. Okay, so currently, if you look at some of the betting odds, quite interesting. I'm not too sure, whether to believe that odds or not, but it's just what it is. If you look at some of the betting websites, they're actually attributing a 29% chance that we may have a Republican sweep, a 28% chance of a Democratic president, Senate leaning towards the Republican, and a Democratic House. So it's kind of a fair view, and a Democratic sweep is currently priced at around 21% probability. So I think, for that, I'm gonna just take it as a pinch of salt for now. I believe that this can definitely change over the coming weeks. As of now, it does seem that the betting odds are slightly leaning towards a red wave as per these odds that we have seen. But generally, when we look at what is the best case for markets over the past, past 50 or even more, years, what we've seen is that generally a split government with a democratic president tends to lead to higher return in the S&P 500. Okay, so we have some of the numbers here. Generally, split government, democratic president, the S&P 500 tends to return around 16.6%. Next in line, if we have a red wave, the S&P 500 may return around 14.5%. Blue wave, quite even, 14%, whereas the lowest return could be a Republican president with a split government. So that will return average annual of 7.3%. Okay, so of course, a lot of factors will come into play. It doesn't mean that whoever sits on that government will definitely determine how much return we've seen. A lot may revolve around economic conditions as well. But this is just just a guide. I think the takeaway from this is that in a way the US market will continue to be strong and deliver very strong average annual return over the years, over the longer term. But of course, when we have that democratic president and a split government, which is the status quo, I think you're gonna see a lot of headlines coming up on this, whereby this is sort of the best case, the best situation for markets and the S&P 500. Okay, now let's just take a little deep dive into some of the policies that both has pitched so far. I think for a lot of attention around taxes, definitely, considering that the previous Trump Tax Cut and Jobs Act that he have enact is set to expire soon in 2025. So both parties will try to extend that. And I believe for the Harris side of things, if you were to look at the table, she is actually targeting the wealthiest bracket. So he will maintain, many of those tax cuts for the middle income, for the low income, but she is really going after the wealthiest bracket. So I believe her view is that, the wealthy should start to pay for some of the budget deficit. And she plans to raise the corporate tax rate to 28% from the current 21%. That is what she has proposed. She offered some tax deduction for new businesses. She wants to help some of the startup, that is fine, the small firms. She wants to quadruple the tax on stocks buyback. So this is significant. I think currently we are looking at a 1% buyback tax, meaning when companies want to buy back their own shares, they got to pay tax on that. She actually plans to quadruple it from 1% to 4%. Okay, so two key things here. One, she wants to raise corporate tax. One, she wants to quadruple the tax on stock buybacks. So that is what could lead to some form of, I believe, some jitters in the markets with a Harris presidency. In a way, like, if she were to be elected, what does it mean for many of those companies that have really been leaning more towards a tax buyback, and whether that corporate tax rate will have a dent onto companies' earnings. So I believe with a Harris presidency, especially when we have a blue wave, all these factors could come into play. We could be looking at some near-term volatility on the on the US equities, considering that Harris tax policies seems to be stricter, seems to be less friendly as compared to a Trump presidency, where he has been more forthcoming in saying that he's gonna make permanent many of the provision of the tax cut that he has previously put in place, and he also gives a very strong tone that he may pursue additional tax cuts on top of that. So clearly, he has been very aggressive in pushing for more tax cut. Whereas for Harris, he is more restrained in a way. And if you go down the table, Harris actually proposed 28% tax on long-term capital gains. She also wants to raise a net investment income tax to 5%. Even though it's less drastic than what Biden has proposed initially, but overall, the takeaway is that Harris' tax policies could be less friendly than Trump. Okay, so what this means for us is that when Harris were to be elected, in a way, there could be some initial jitters around equities, and some of the sectors that could potentially be most sort of, I call it most hit by these buyback taxes could be technology, could be financials, could be communication services, could be industrial and healthcare as well. So these are the sectors whereby the companies tends to do more share buybacks as compared to the other sectors. So I think with that view that your buyback tax may potentially be quadrupled from current 1% to 4%, there may be some shunning of these sectors on that uncertainty. But I believe our overall view is that even if that scenario were to be in place, of course, we have to look at whether we have a divided government or not. Because if we have a divided government, what this means is that many of those, that tax that push through in terms of tax increase could be harder to pass. And of course, if you just backtrack to past historical instances, corporate tax has actually been much higher than current period. Okay, so currently it's at 21%. Back in before 2017, it was actually at 35%. And even if Harris were to follow through with that raise in corporate tax from 21% to 28%, it will still, in my view, remains low by historical standard. And generally, when we see corporate tax being 35%, stocks can still gain. So I believe that any near-term jitters, around all of these stricter tax policies should be a buy the dip opportunity, especially when we have any divided government that just suggests that any pass-through will be harder to come by. And on the topic of buyback tax, previously it was imposed at 1% back in 2022. We still see companies increase the level of buybacks. Of course, you can argue that now we could be looking at a potential quadrupling to 4%. That will definitely come with a larger impact. But our view is that eventually companies may adjust, and they may still turn towards buybacks, or even if they are too concerned about that that higher tax amount, dividend payout could remain an alternative for companies. So that will still continue to sort of benefit shareholders, and therefore we believe that the overall impact could be limited. Therefore, we believe any weakness or any jitters around that tax policies may potentially offer some buy the dip opportunities. Okay, moving on, let's look at the next key areas of interest, foreign policies. No doubt, Trump has been very aggressive. If you just look at some of the aim that he hoped to push through, he wanted to phase out imports of essential goods. He has been very clearly focused on that mission to put America first. Okay, and his view, he's a businessman, so no doubt his view on foreign policy is very transactional in terms of what the allies can bring for him for the US. And he believes that any sort of exchange, I believe, should be fair. Whatever benefits that you give me, thereafter, I can give that same benefits to you. If there's sort of what he deemed sort of unfair treatment, he wouldn't hesitate to enforce, stricter rules or regulations on you, even though you are an ally of a US. So I think that has been his stance. We have learned a very strong lesson back in his presidency 2016. 2018, he actually sort of started this trade war with China. That was a period of uncertainty. Nobody really knows how it will impact trade activities. So with him if he were to be elected as the next president, I believe it will be a repeat of 2018. Okay, what this means is that there will be potentially more global tariff, and what this means is that inflation could potentially be more persistent. Okay, because if you were to draw lessons back to 2018, when US implemented many of those tariffs on China, there is no doubt that the imports from China has dropped, but the imports from other countries have actually increased. And when we look at the trade activities between China and the rest of the world, it has increased as well. But of course, with US, it has dropped. So what we see is that, when you have all these tariffs in place, it could potentially just means a rediversion, a redivision of, of that transfer of goods or services itself, as opposed to a full decoupling, whereby many companies may still, China goods may potentially still land in US ground, but it could go through other companies as compared to a more direct form of a trade relation. And what this means is that previously we could be looking at a higher inflation, a higher global inflation where prices of goods may go up to factor in the tariff, and that is generally borne by consumers and businesses itself. So our view is that if you have a more aggressive trade tariff in place, it could potentially slow down the global economic ground, considering that consumers may be looking at higher prices. It may weigh on their propensity to spend. So that can be one of the key risks that we may be looking at, especially when the world is sort of still sort of struggling with above target inflation. If you were to implement more tariffs, they're just going to make inflation more persistent, and that will complicate the Fed's or central banks' fight against balancing inflation risk and growth risk. So it will definitely be sort of more complicated with his presidency. Of course, either side, competition with China will continue, but previously mentioned, Harris may lean more towards subsidies and regulation for US industry, while Trump may more outrightly turn towards punitive measures on trading partners. And in terms of what this means is that with a Trump presidency, there may be more uncertainty, and there may generally be sort of a flock to safe haven assets such as gold. Back in 2018, we have seen that play out when we see this tit for tat measures, gold actually gain quite significantly. But of course, we have to understand that safe haven flows could potentially be short term, meaning that when there's uncertainty over all of these trade restrictions, there are very strong safe haven flows into gold. But thereafter, once markets get more and more clarity over what all these tariffs mean, generally we could be seeing some form of a slowdown in terms of gold prices growth. So I believe that Trump presidency, if he were to be the president, any form of a tariff, we could see gold prices gain. So we will want to be positioned in that. Whereas for a Harris presidency, things are more certain. Things are more of a status quo. We are likely to see a normalcy to US foreign policies. That wouldn't have too much of an impact for gold, and gold may just take its cue from other areas such as Fed policies and economic conditions by itself. In terms of foreign policies, what we are leaning towards is that we believe either side will benefit defense stocks. When we have a Trump presidency, I think he has been very aggressive. He has been saying, he has been telling NATO to sort of up their budget, defense budget. If not, he's not gonna defend his allies. So I think what this means is that with a Trump presidency, defense stocks, especially in the Europe, may see some traction. Of course, back in US as well, I think we may potentially see an increase in defense budget. I think Trump has been very forthcoming in saying that he wanted to end the war with Russia. He wanted a sort of a quick and decisive end to those many of those geopolitical conflicts. How he's going to do that, I think, is still lack clarity at current point in time. But what this means is that the geopolitical picture could turn more volatile and uncertain, and therefore, we are happy to sort of lean towards defense stocks in that way. And for a Harris presidency, I believe it will be a continuity of the current situation where the Democrats will continue to throw their support behind Israel, will continue to throw their support behind Ukraine, which suggests that many of these conflicts may last for longer. And what this means is that there may be potentially more aid in terms of defense equipment being issued to some of those allies. So either way, we believe that some of those defense stocks may continue to gain traction. But for a Trump case, potentially we could be looking at some of the defense stocks in Europe as well, just based on his tougher stance, based on his him giving more pressure onto his European allies to really up their defense budget. Okay, now we move on to some of the more lighter policy, I would say, around immigration and around healthcare. We know that Trump has been very anti-immigrants, and with his presidency, there is no doubt we will be looking at a stronger immigration control. He pledged to raise deportation efforts. He aimed to complete the border wall. These are some of the things that he has said many times before. What this means is that when we have a sort of a tougher clampdown on immigration, it may limit labor supply in the US, and that may translate to rising wage pressure. But of course, I believe the overall impact is still uncertain yet. I think, yes, labor supply may potentially be clamped, but we know that the US jobs market is also softening. So labor demand is falling, and hopefully, how that balance out is still very much a question. But in a way, Trump has been very aggressive in pushing for stronger immigration control. How we can actually benefit from that is that there are some stocks that are related to private prisons. If you have sort of a tougher stance on immigrants, those stocks are generally pegged towards a Trump presidency. So later I'll share with you, in a very precise table, some of the stocks that will benefit from, this immigration policies itself. On the issue of healthcare, I think it's quite obvious that both candidates actually want to clamp down on drug prices. They believe that it has been slightly unaffordable for the US public, and they both hope to see some form of a control on the drug prices. So with that, healthcare is put into the limelight as per previous election. But the thing is that if you have a divided government, many of those healthcare policies, as we have seen over the past few years, it will be met with a lot of resistance. It will be very hard for the government to come to a clear consensus. And therefore, I believe that if we have a divided government, many of those pharma companies may actually benefit as compared to, a clear-cut red wave or a blue wave where it makes, many of those healthcare policies easier to pass through. So healthcare companies will prefer a divided government, and we have that, which is the status quo. I believe there may be some traction for many of those pharmaceutical stocks. Okay, now we move on to some of the key areas around energy and technology. So I think both candidates actually differ very far apart in terms of the energy space. So previously, when Trump was the president, he has a rollback. He has been very pro the sort of pro dirty energy. So he has actually sort of unwind many of those regulation in place for the energy sectors, and he mentioned that he will want to sort of terminate that Green New Deal. He really want to cancel Biden's EV mandate when he is the president. So these are the things that he has said. So in a way, he is sort of less inclined towards supporting clean energy as compared to Harris, which takes on a totally different approach. So if you look at Harris' track record, when she is the vice president, she has a very strong history of going after many of those oil companies, pushing for punitive fines if they don't play their role for the environment. She has also played a determining role in passing this Inflation Reduction Act. So if you do not know what this is actually one of that huge policy passed during the Biden's administration, where we see that largest investment in climate action in history. So she has actually been the one that delivered that determining vote to pass through this Inflation Reduction Act, which has a clear focus on transforming the environment to be friendlier. And with a Harris presidency, no doubt US will remain in the Paris Accord, as opposed to Trump, who previously put the US out. So the direction in terms of the energy sectors differs significantly. So with a Trump win, what this means is that we may see some traction coming for oil companies on this deregulation, this lighter enforcement on the environment. Of course, it will be bearish for clean energy. He has been sort of trying to target some of the tax incentive for clean industry, and he wanted to cancel, the Biden's EV mandate. So what this means is that generally, clean energy may see less support with Trump. And of course, it will be bullish on the US auto industry. We could be looking at Ford. We could be looking at GM, which has some parts of its auto fleet being exposed to to a EV, but it's still not that huge significant part of their businesses. So with that lighter push, in that EV mandate, generally, the auto industry may also gain some traction. And on the technology side of things, generally both has been calling for some form of control for a big tech. But generally what we are looking at is that the Trump presidency may deliver a lighter regulatory touch around AI and other emerging technologies. Of course, many of those tech antitrust enforcement case may continue. But in a way, his win may be deemed as less negative for the big tech sectors. And of course, when you look at some of his friendlier tax policies around the wealthy, it will benefit many of those tech billionaires. And of course, the share buybacks, where any of those big techs tends to turn to support their share price. So generally, I believe a Trump presidency may be more positive for the big tech as compared to Harris. Of course, for Harris, she has been taking on a firmer stance against many of those tech companies. She wanted stronger privacy laws. She even want to hold social media platforms accountable for content moderation. And previously, back in 2019, she mentioned that she's open to break up big tech by itself. So in a way, with her taking on that top seat, we could be looking at some public oversight in AI, largely a follow-through of what Biden has been doing. So recently, the DOJ has been coming in and has been sort of scrutinizing many of those tech acquisition and mergers that could be set to continue. It creates more of a less friendly environment, we believe, as compared to Trump. Okay, moving on, we have financial and housing. Generally, these two may slightly carry a more uncertainty. We didn't really have too much clarity on what they actually plans to do around these sectors. But just looking at past history, previously when Trump was the president back in 2016, he actually weakened many of the big bank regulations. We believe that could potentially play out again if he were to sort of take back his seat as the president. And back in 2018, he is also the one that eased many of the financial regulations around this economic growth, regulatory relief, and consumer protection act. So that may be set to continue. We can see where he is leaning towards more deregulation, which could means more room for the bigger banks to maneuver and try to reap greater profits. So in a way, his win could be positive for the financial sectors. Whereas on the other hand, Harris could be taking on a slightly tougher stance. We may see her continuing to advance the Biden's administration agenda for tough financial rules, some cracking down on bank fees, requiring more transparency from hedge funds, so on and so forth. So generally, Harris may be seen as less positive for the financial sectors, but of course, many of those still lacks clarity, and this is just what we have observed based on history. But generally, on the topic of housing, I think we could see some slight traction, at least for home builders on either side. What we are seeing in common from both sides is housing grants, extension of tax incentive. Those may lead to higher disposable income, which generally support housing demand. Okay, last but not least, the key highlights around their policies, breaking down to digital assets, the crypto space, and some of the spending that they hope to push through. So no doubt we have heard Trump has been very active in throwing his support behind crypto. To me, I view it as a potential strategy in his campaign. We know that the crypto space has seen a huge ramp up in terms of wealth for many of those cryptos figureheads or founders. By him throwing his support behind that industry, that crypto industry, he may potentially earn some of the higher donations potentially for his campaign. But of course, that is just my guess, but I believe that is what he's going for. And he mentioned that he wants to end a crypto crackdown. He opposed the creation of this central bank digital currency. And more importantly, he aimed to create a stockpile of Bitcoin. He mentioned previously what this means, clear-cut higher demand for Bitcoin. That should be that should bring about a more broad-based impact. Because if you have the US government sort of holding Bitcoin, generally what this means is that regulation may start to open up more freely in that sense. Whereas for Harris, I think she didn't really say much about what she thinks on the crypto industry. But just looking at over the past, 2 years where she is the current vice president, we are seeing some form of crackdown on the crypto industry following that FTX saga right there. So in a way, I think markets tends to attribute Harris as being a tough kind of a figure in the crypto space. So with her re-election, I think it can generally be sort of a negative for the crypto industry. And of course, lastly, in terms of spending, I think Trump hasn't been too clear on the sort of where he hopes to sort of spend. But he aims to slash some of the what he deemed wasteful government spending. He aims to strengthen military and complete that border war. Whereas for Harris, I think her agenda revolves around clean energy, pushing through infrastructure, support for home buyers, some of the student debt relief, and also foreign aid. Okay, so this is the overview of their policies agenda. We can see that there are some common areas, namely around, potentially some push in infrastructure spending, some extension of tax cuts, and that focus on lowering drug prices. But of course, there are room where they actually deviate in terms of the extent of a tax cut that they may deliver. Harris being slightly more measured in that sense. That foreign policies that are way different, with Trump turning towards tariff, which is inflationary and is bad for global growth, whereas Harris seems to be more bring more clarity, and that may be well checked by the allies. Of course, some parts they differ in terms of the energy sectors. One clearly leaning towards dirty energy, one leaning towards clean energy, and immigration as well. So there are some common areas, but of course, there are definitely areas where they actually diverge from each other. So now let's take a look at some of the historical performance, how the S&P 500 actually perform based on past US election. This is the S&P 500. If you look at past historical US election, generally things are quite stable, I would say. 1 month before election, which is now. 1 month after elections, there may be some form of uncertainty there. We are looking at a slightly lower average return, and a median is also, not great. So there may be some form of the uncertainty, in the aftermath of that US election. But thereafter, as we go on and on, generally performance should improve over time. The percentage of positive performance should also improve over time. So what this means to me is that potentially we could be looking at some of the impact from US election can be short-lived. No doubt, 1 month before, 1 month after, there may be some impact. But as things progress, as markets get more clarity around many of those policies, the focus will start to shift towards the broader economic conditions and so forth. And generally, we see an improving performance over time. Same thing for the Nasdaq. I think the Nasdaq has been more clear in terms of that uncertainty before election. Generally, before there tends to be more jitters. Thereafter, things also starts to improve over time. And the scale of improvement, 3 months, 6 months, or even 1 year after the elections can be sort of significantly higher than the S&P 500. Russell 2000, the small caps, I think generally the trend remains the same, mixed performance in the lead up all the way, sort of until post elections. But thereafter, we see a trend of improving performance over time as well. For the STI, data set is limited. We only have 6 presidential years for our STI record. But generally, 1 month before elections, STI tends to perform quite weak. Average of negative 4% return. 1 month after, things starts to pick up, 2%. 3 months after, 5%. 6 months after, 9%. So improvement also starts to play out for our local markets as well. Okay, how about gold prices? So I think very interesting is that we really got to monitor when we have a Trump presidency. We got to monitor some of the global trade uncertainty. Historical performance for gold prices hasn't been very assuring. If you look at just the average performance pre-elections, even up to post-elections, even 3 months after elections, the general performance tends to be weak. We are looking at very low positive rate here, 40%, 30%. We're also looking at negative returns. So generally, gold prices doesn't, at least, these numbers show that gold prices doesn't gain much traction before and after the US elections. But one of the caveat that I will say is that back in 2018, when we had that trade war, we actually seen a very, very strong boost in gold prices, because when there's global trade uncertainty, there is sort of a rush from markets towards a safe haven, and gold tends to benefit from there. So in this case, yes, I mean, with a Harris presidency, gold may not actually react much to that outcome. But if we were to have a surprise Trump presidency, markets may start to sort of relive the memories of 2018, where you have that trade war, and any reaffirmation of tariff from Trump itself can actually be beneficial for gold prices. But like I mentioned, I believe any impact can be short-lived. Back in 2018, when there's high uncertainty over global trade activities, gold prices seem to ramp up. But thereafter, things starts to unwind fairly quickly, I would say, once more and more clarity emerge. But it still provides some form of a short-term trade opportunities, where if we see a Trump presidency, gold prices may remain more well supported. Okay, silver prices, same thing. Not a very convincing long here. 1 month after election, 3 months after. General performance doesn't look too fantastic for silver prices. For the US dollar index, impact can be more mixed. I think apart from that US elections, of course, whether many of those trade and fiscal policies can be pushed through will still play a very determining role. Therefore, we didn't really see too much of a clear trend here in terms of the US dollar. I believe we really got to take things as it goes, on whether we have a divided government, or we have a clear unified government where fiscal plans can be pushed through more easily, especially when we have a red wave, more aggressive tax cuts, punitive tariff in place that is inflationary, and that will translate to strength in the US dollar. But we really got to depend on how some of those scenarios actually come into play. But generally for US dollar, seasonality wise, over the past 50 years, September tends to be weak. October potentially a slight rebound, but towards the end of the year, November, December, things starts to be weaker. So something to take note there, where we could be looking at some resistance for the US dollar into year end, generally based on seasonality. Okay, so to round up, I think this is some of the table which can be that key takeaway for today. With a Trump presidency, I believe the US dollar may go up, largely because we are looking at inflationary tariff. We are looking at tighter immigration law that may drive wage growth higher. We could be looking at a larger fiscal stimulus that may be inflationary, and that will complicate, many of those Fed's easing process. And previously, back in 2016, when we have Trump delivering that surprise victory, there was actually a boost in the US dollar in its aftermath. So now I think we are back at a situation where Trump hasn't been that hot favorite to win the seat yet. So if you were to deliver that surprise win, I think similar situation could turn out. That should drive some strength in the US dollar. Gold, with a Trump presidency, likewise, more uncertainty around the global trade war, that could drive safe haven flows for gold in the near term. But eventually, what we observed back then is that with a stronger US dollar, some of the gains tends to fade over time for gold prices. So it does offer some sort of short-term opportunity rather than a buy and hold situation. Defense stocks, not just in US, but we are leaning towards European defense stocks as well. Some of the key points: Trump wants to raise defense spending for NATO members to 3% of GDP. I think his threat to remove some of the support for NATO if they don't up their budget, is significant, and that should translate to some traction for European defense stocks, especially US stocks may benefit as well. Previously, he mentioned that he may want to pull out of NATO. Whether it will play out, very much up in the air, but he actually has that priority sort of in place. If it were to play out, it may actually call for the need to increase many of those military outlays for US defense as well. So energy auto stocks will go up based on his more oil and gas friendly agenda. But gains for energy companies, I believe, may be short term, because what he hopes is to ramp up oil production. That could actually limit oil prices upside, and whether that translates to higher profits for energy companies is still uncertain. So I believe that any gains, with his win, could be short term. Longer term tends to carry more uncertainty. Solar, clean energy stocks may be impacted. Of course, the impact on oil prices may be mixed as well. If you were to push through tariffs, we could be looking at a more uncertain global demand. And if you were to ramp up US production, all of this really seems to have an offsetting impact on his deregulation efforts, or even, some of his tougher stance on Iran, for example. So I think impact on oil prices may be mixed, but generally energy companies may see some short-term kind of attraction. Financial, infrastructure, cryptos, big tech may see some form of a traction. For infrastructure, of course, we got to see a more unified government. In this case, it will be the red wave, but all of this industry may ride on that deregulation kind of a theme. Healthcare, if we have a unified government, healthcare reforms may be easier to pass through, then the healthcare may see some shunning, at least in the near term. Some of the more Trump-related stocks, we have Trump Media, Joe Group, Core Civics. Joe Group and Core Civics are actually private prisons, a listed private prisons company in the US. So they are linked to a Trump victory because of his immigration law. If he's being tough on that, generally, Joe Group, Core Civics may see some form of attraction as well. Chinese equities, clearly on the downside, that tariff story again. Emerging markets, emerging markets tends to be more trade-oriented economies. So, with that uncertain trade backdrop, that is going to potentially weigh on many of those countries. So Taiwan, South Korea, Mexico, China, they are highly exposed to trade with US. Back then, when Trump actually took the seat back in 2016, there was actually a sort of a knee-jerk reaction in many of those emerging economies. For a Harris presidency, that is the current base case based on the pollings, and it's also that less disruptive scenario. It's very much more potentially a status quo. We could be looking at a weaker US dollar. We could be looking at some of that traction towards riskier currencies. Given that if we have a status quo of the current situation, it suggests policy continuity. And what this means is that it removes some of the US election uncertainty, and that generally translates to a drift higher for risk assets. Of course, clarity over US relations with its allies may also offer this slight boost. So we do see some form of a risk-taking here. Defense stocks may increase as well. Continued backing for Israel and Ukraine. Geopolitical conflicts may drag for longer. we may be getting more need for military support. Energy stocks down, solar clean energy stocks up, based on that, of course, based on that continuation of the Inflation Reduction Act that Harris will likely push through as what Biden administration is currently doing. Infrastructure may go up. They have been pushing for massive infrastructure spending, but of course, we need a blue wave for a successful pass through of that. Financial, crypto, healthcare generally down, and of course, the opposite is true for emerging markets where we have more certainty over trade activities. That may drive some relief flows back for the EMs. And if you have a weaker US dollar, that is bullish for EMs as well. Whereas Trump-related stocks, not a surprise, we should see some form of a sell-off in the event of a Harris presidency. Okay, last part, let's just look at some of the key technicals for some of the ticker that we're looking at. One is that clean energy ETF. Currently, it's still very much, very tame in that way. But what we are observing is that there is this sort of wedge pattern playing out. If we see a break above, this wedge formation, the projection suggests, some potential move towards that $18 level. Energy sectors ramping up, coming up on a rising wedge formation. Based on this, generally when we see a breakdown of that lower trend lines, then that could suggest sellers in control for the energy sectors, and we should see, sort of further downside on that. Gold, I think, really not reacting much to that US presidential election, I would say. I think more of it revolves around Fed rate cuts. We are seeing some traction lately with markets starting to price that the Fed may have to move by another outsized 50 basis point in November. That is generally supportive of gold. We're also seeing some geopolitical tensions that should support some flows for this safe haven as well. But generally, I would say the impact from the US election hasn't really been having too much of an impact on gold just yet. But of course, if you were to see any surprise victory from Trump, in the case of 2016, there may be some form of a short-term flows coming in. So you got to see about that. US dollar, generally weaker on the downside, really not gaining too much of a traction. Hard to really go against the Fed policy, which is heading into an easing cycle. And there is the risk that, the Fed may have to take bigger steps of rate cuts, to prioritize supporting growth conditions. US dollar still seems to be on the downside. But of course, if we were to see any shift in odds towards, a higher chance of Trump being the president, we could see some traction return for the US dollar. But as of now, I think there is still, is still on the downside. Nasdaq, generally upward trend should persist, higher highs, higher lows. But of course, near term, the question is whether there is still catalyst in place. We believe that it could still be volatile into the earnings season, but the broader upward trend should persist as long as as long as the Fed can still continue to sort of deliver that soft landing itself. Of course, the risk here is that we have that US non-farm payroll coming up early next month. If that were to tick closer to the Fed's target of 4.4%, or even the worst case is where it exceeds the Fed's 4.4% unemployment rate projection for 2024, it will really trigger a lot of concerns that the Fed is really running behind the curve in terms of rate cuts, and we should see some form of a sell-off or retracement. But generally, based on this trend, any form of a dip should offer some buy the dip opportunity. We are looking at maybe some slight weakness towards that 200-day moving average, and also sort of near to the upward trend line that we have drawn around that 18,100 level. Okay, so come to the end of my presentation. I think I have overrun a little bit, but of course, really hope that just to really hope that you have some takeaways in terms of the candidates' political agenda, how to really lean towards some of the sectors or assets class such as the US dollar gold that you can lean towards as we head into the US elections. For now, I believe things are still fairly muted, but as we head closer towards that D-Day itself, we may see some of these asset class react more. But thereafter, once we have a conclusion on who will be the next US president and whether we will have a decisive wave or not, then many of those trades may start to unwind. But nevertheless, these are some of the, I believe, near-term trade opportunities that you can potentially position yourself. Okay, so with that, I will look at some of the questions. If you have, just feel free to type it on the question tab. Otherwise, I have this QR code here. You can scan it and then do tell us what you actually hope to see potentially in the next webinar. Okay, I think one of the questions, impact of the US election on Singapore and SGD interest rate. Yes, for Singapore's case, Singapore is very trade oriented. Our economy is very trade oriented. So generally, when we have, I would say our stock market may prefer a Harris presidency. If we have a Trump win, what this means is that we may be looking at more punitive measures on China, which is one of our largest trading partners as well. We could be looking at some of the pressures, and it really wouldn't be beneficial for the Singapore's economy. We could be seeing some jitters around that uncertainty over that trade backdrop. And if we have a Trump presidency, policies tends to be more inflationary. That generally may weigh on emerging markets, which is in a way Singapore. For SGD wise, generally we could be seeing some jitters or potentially a further weakening in the Sing dollars against the US dollar in the event of a Trump win. So that is the impact that I foresee. Okay, any other questions? Do feel free to put it down in the question tab. Okay, if not, I will just leave the QR code here for just a little while. Yeah, do feel free to let me know what you want to see for the next webinar, and I'll try to cater to that for next month. Okay, I have one question. Will it be possible to have the slides of Trump and Harris victory impact on the market table? Yep, sure, no problem. Let me just, yeah, I believe you are looking at this. I'll just flash the Trump slide first. And yeah, maybe 1 or 2 minutes later, I'll just flip it over to Harris impact. Okay, yep, so here is the Harris side of things. Yeah, by the way, this webinar will be recorded. We'll see whether we can, sort of upload anywhere if you want to revisit some of the slides or content. Okay, so I think with that, we have come to the end of our presentation. And thank you all for joining in today. And of course, this week we will be looking at more economic agenda coming out from Trump and Harris. So we're gonna keep a lookout on that as well. So thank you very much, and I hope you have a great rest of the evening ahead.